Hello, everybody. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown where we forecast price movement in GameStop using technical analysis and a close look at the options market. Welcome back. I'm your host, Dr. Michael LoPiano. Very good to see everybody. Welcome back after a wonderful Christmas week. A short week. We're heading into another short week this week. But interestingly, we are heading into a short week after an unexpectedly high weekly close on 12/27. That's right. Not only did we get a weekly close over $30, but we actually got a close a decent amount above $32. This key options level that I spoke about in the middle of our trading range last week. I did not expect us to see a close over $32. If you went ahead and took a look at last week's article, last Friday's write-up and analysis, you'll know that I was looking at something in the ballpark of probably around $31, closer to 31, maybe slightly below that, given that our max pain had moved up to $30 by Friday's trading, but that 32 position was so big and would represent a less than optimal profitability point for dealers, for market makers, specifically the options market makers in GameStop Wolverine trading. So with that in mind, $32 was a bit of a surprise. We'll talk today about some of the factors that went into that close, as well as what we might be able to expect from this week as we continue to see developments out of that general bullishness toward the end of last week. So let's hop into it. So for those of you perhaps who are here for the first time, who maybe have not gotten a look at the open interest newsletter, I publish this analysis every day pre-market. It is available now live on my X page. You can go visit it there. The link, if you're viewing this on YouTube, is down in the description of this video. Obviously, if you're watching this video on X, then it is available at the top of the page, pinned as always. So indeed, let's get into it. Right, so today I want to start out, as we can see, not only on Friday were we looking at a $30 max pain finish, as we come into our first options expiry period in January, the 1/3 weekly options expiry, we are already at the start of the week looking at a $30 max pain finish. So I should say max pain level. We don't know if we're looking at a $30 max pain finish quite yet. But certainly seeing us at $30 heading into the week is a good sign for continued trading in this $30 to $35 bracket that we've been knocking on the door at for several weeks now. Really, we were doing this all the way back prior to this big Thanksgiving sell-off, this huge short volume induced sell-off that pushed us back through that $30 call wall on that initial breach and into this trading in the $25 to $30 bracket once again, right? So this $30 close last week, the first time we even saw a max pain level that high throughout the entire year. Yes, that's right, even including the May and June periods where we traded up into the stratosphere, right? Up to $80, $60, $45, right? All over this area. No matter that upward volatility, that dynamic bullish price action around the time that Roaring Kitty, Keith Gill returned to X with quite a few interesting meme posts, to say the least. Right, not even in that did we see a max pain value higher than $29.50. In fact, we saw just one, $29.50 in June. That was indeed the highest we saw all year prior to last week's weekly options expiry at $30. And that's what we see here. This is very encouraging. Certainly, who could have seen this coming? Right. And as we hop into this, right, in the post, I go into this in deeper detail, but I noticed recently some other people on X have also called this out. Gotta point out Ryan Cohen here, especially. I know a lot of attention has been on Roaring Kitty recently, but interestingly, if you go back, right, I posted this, I commented on this when the X post came out, when the tweet came out. Ryan Cohen has been doing TA the entire time, it seems, right? He's got this email your portfolio to TA team. He apparently has this GameStop email address that you can send your portfolio into. You can apply for supposedly job listings. This one really stuck out to me, right? I didn't pay super close attention to these until this one on December 23rd, right? And he says, looking for a highly talented and creative motion designer for a few months, maybe more, email your portfolio to TA team at GameStop.com. Now, obviously, right, the external appearance of this is talent acquisition team, of course, to go work for GameStop. But of course, TA can also mean technical analysis, one of the primary modes of taking a look at our price action that I rely on principally and that we discuss here with these breakdowns. So, right, if you actually go back and look at when Ryan Cohen put up these posts for TA team, we can see that they occurred right at the support of key levels that then was followed by a significant reversal in price. So if we take a look at just before he tweeted, right around when he tweeted, or I should say posted to X, this motion designer application for maybe a few months, right? GameStop immediately went on for the next 7 days, it reversed, right? It touched this key level in our major bullish regression channel, our main bullish regression channel that we've seen develop over the past now about exactly 2 months, and moved all the way to the top of the channel, right? We poked a little bit up outside of that channel, 34.37, right? So if you bought GameStop at his tweet, right? I mean, that's a pretty good trade, right? That's a pretty good trade. It turns out, I decided to go look back here, right? Many people mentioned, okay, he had his deleted YOLO tweet or his Trump is the shit post, something like that. Going back here, right? This is when he tweeted that on October 25th, if I'm not mistaken. And that was, if you're going to enter, right? If you're going to enter the trade, that was to take advantage of some of this price action. That would be the time to do it. That would have been the time to do it. Of course, I was writing about this a lot, looking at the TA in general, taking a more detailed approach to this, but it's pretty cool that Ryan Cohen's also looking at that at the same time. Turns out, if you were watching his Twitter all the way back in April, on April 15th, he posted that he was looking for hardworking operators with experience in retail and supply chain. Not sure what that means. Job based in Dallas. Not sure what to necessarily decode in that particular tweet, but certainly, get in touch with the TA team. And when did we get that 3-year bottoming in GameStop? Well, it just so happened to be April 15th. So way to go, TA team, calling those out. So just something to notice there as we hop into our own technical analysis. Certainly looked that way, right? Last week we got, as we were heading into Friday's trading, we got basically what I figured we'd be looking at. In fact, I wrote about this. It developed quite a bit faster than I thought it was going to develop, but I was looking at something around the $30.75 range as a low on the day, possibly too. I also spoke about this in the post. Possibly it could have showed up on Monday, basically where I was looking at things from the beginning of the week, but we got it really fast. You'll recall as well, I wrote about looking at the shortable shares, right? Shares available on loan from published by international brokers. And I noticed that several 100,000 shares in particular seem to be preemptively borrowed from that 900 to 950,000 share pool that seemed available during pre-market trading hours, but we didn't see them deployed, as you can see here in the pre-market trading. This said, okay, we're pretty high. We're pretty close to 33. We're above 32.50. I have to assume that market makers are going to want to see the price lower. We have so much accumulated options, gamma exposure, call gamma exposure at $33. We have so much at $32. These are big call gamma accumulation positions. I have to imagine that they are going to want to see these lower. So I would not be surprised if institutions, maybe a market maker, maybe Wolverine Trading, maybe Citadel or something like that, who knows, right, was borrowing these shares in order to push the price down so that they could position the stock within a more favorable charm environment, right? So I wrote and talked about on Friday's video, as the price remained above $32, while those $32 calls remained in the money, GameStop was in a positive charm environment with respect to those large call gamma positions. Positive charm, meaning that as options expiry approached, as more time went on throughout the trading day, it meant that the delta values, the delta change over time for those near the money but in the money options was actually ticking up. So this meant that as time passed, dealers were going to have to hedge more shares. We're going to have to buy shares to hedge those increasing delta values throughout the day. While the price, however, remained below $32, all of those, say, 8,000 or 9,000 contracts, those 8,000 or 9,000 calls at $32, while they remained out of the money, the price was rather in a negative charm environment. This meant that those contracts had negative delta appreciation, or I should say delta depreciation over time throughout the day, which would enable dealers, instead of having to buy shares to hedge those delta positions, they would then sell shares. They would have the ability to sell shares, cause a slight depreciation in the price in order to comfortably allow those contracts to expire out of the money. And it looked like that's what they were setting up. However, even after this very, very steep drop that we had in the morning, we traded back up to about VWAP, right? I thought, okay, trade up to 32. We basically just about reached 32 and then started to fade off, right? This just looked like, okay, right, there we go. There's the trade, reversal in the options market, trade back down to VWAP. They can start, now we're heading into a negative charm environment with respect to that $32 position and that $33 position. We can start to sell shares, don't need to hold on to these hedges, and that seemed to work. But interestingly, and somewhat inexplicably, the price started to trade up at the end of the day. I mean, look at this thing that headed into the after hours. Not sure what this was. Did not show up as a lit whale order. I go into this in detail in the analysis. This was not an options-induced move. If we look at our options orders, right, any options orders, I sort this by premium values above $1,000. Almost all of our trades heading into the end of the day in the last 20 minutes or so of the day are bearish, right? These are bearish trades. In fact, if you take a look, we also ended up pretty sizably, right, moderately to heavily skewed toward bearish trades on the day. So this would say, okay, well, these are new trades, or these are trades that, because they're bearish, they are going to influence market maker hedging toward the downside, right? So for example, you go and sell a call, you put a long call on a market maker's book, they're going to go and they're going to short shares, or they'll sell shares that they're already holding as hedges, because you're putting positive delta on their book with that long call. If you're putting positive delta on their book, they want to remain delta neutral. They're going to sell shares, or they're going to short shares in order to equalize, in order to neutralize the delta values on their book. So we had a lot of bearish volume. This means that this should be net stimulating dealers to sell shares, to short shares, to alleviate some of the excess positive delta that they have on their books, say from these, from the long calls that are being forcibly put on their books, or these, or say closed from their books potentially, or puts, right? Or short puts that are being put on their book. But interestingly, despite all of this pretty heavy bearish action into the end of the day, that's not what we got in our price movement. Not sure what was going on there. Were there any major dark pool buys? We had this 37,000 share VWAP order, average price order, that was assessed throughout the day and then was processed, was finally settled via a dark pool trade. But 37,000 shares is not enough to cause that type of movement. That's not a lot. And we didn't really have anything in terms of lit whale orders, at least nothing that Unusual Whales was describing. So where's this volume coming from? Is it retail traders, or just all of a sudden in the last 20 to 30 minutes of the day are just picking up hundreds of thousands of shares? a strange thing to propose. Doesn't seem likely. That doesn't tend to happen. This looks something like something that had to do with settlement, right? Potentially, it could have been that shorts earlier in the day decided to use that opportunity, if it wasn't a market maker themselves, to buy up some cheap out of the money calls, and then use their short covering in order to really drive those calls into the money, to cause them to appreciate as in response to their own covering, their own buying to cover their earlier positions in the day. That's possible. Certainly, it looked like those short positions were settled in the shares available to loan. Right, we went right back up to 900,000, 950,000 over that period. So that isn't definitive, but something like that, right? So this seemed to me to be something potentially unexpected, not directly in the interests, at least ideally, hypothetically, of market makers. So that was very interesting to consider and interesting to point out that we do have these types of bullish events kind of occurring in the background. We saw a lot of that for 12/20 December Opex, triple witching. We saw 3 to 4 million volume weighted average price orders get assessed, get settled in the after hours period. So we're seeing a bit of that. We saw some of that on Monday. So something is going on in the background here, right? There are either bigger players, or there are potentially these FTD settlements, these ETF failed to deliver settlements that may be being processed in the background. Maybe REX, so Regulation Extension Code 68, margin settlement or margin requirements being met, something like that. The type of stuff that Richard Newton talks about, has been studying for a while, that came out this recent Big DD by otherwise category. Definitely go check those out if you haven't had a chance yet. So maybe something like that going on in the background, but just interesting to kind of to see that being processed. So as we look into our technicals for this week, right, since it turns out, okay, Brian Cohen definitely pointing out, oh, hey, these matter, right? These levels matter. I mean, I wouldn't be surprised. He tweeted here and the price ran to here when it reversed. Like, I mean, you can't make this stuff up, man, right? We're continuing to look at our 4-hour, our principal paradigm is on our 4-hour chart. We did have this big reversal. What this says to me is that, okay, we're probably going to settle a bit back towards the middle of the channel. Yeah, it's a little crowded, right? I have some historical marks here. I mean, sometimes historical price levels operate kind of as psychological supports. But really, right, we're taking a look at our moving averages, and we're taking a look at these regression channels. We have sort of what became a range-bound channel that now is a sort of sub-channel after this kind of Thanksgiving reversion. We used these levels last week. So we used the midline of this channel as a reversal point. This is part of why I pointed out in my write-up on Friday, why I pointed to $30.75 as a reversal point. It did serve as a reversal point, slightly above it, right, or slightly below that, $30.73 as a reversal point. What it looks like, because we've only had a day of kind of correction off of this RSI overbought level, we did go ahead and run the full length of the upper half of our bullish regression channel. I would say in the short term, based solely from a technical viewpoint, from a technical standpoint, what seems to be most likely would be that we would come down and touch the 20-day moving average here, right? Maybe we hang out in this zone a little bit, the top of the smaller channel and the midline of our broader channel, before maybe heading down to test some consolidation atop the midline of this channel. Again, since we've explored it as a support, and maybe wait for the 50, this would be the 54-hour simple moving average to come up here and establish a support, specifically because we used it so definitively in the first half of this bull trend. So we scrupulously respected this particular line. We were actually looking to respect it again back on December 2nd, when a conspicuous amount of interventive short volume came in and just blasted us through that technical level, all the way down to the 104-hour moving average, which was a little precarious, right? That was a little precarious. until we got that post by Roaring Kitty, and then of course it held up again, a bit unexpectedly, but held up again thanks to the bullish reaction to earnings. So I would expect, again, just based on technicals, a retrace to the midline of this sub channel, and perhaps then a deflection or a reflection, maybe a movement back to the upside into the next couple weeks, once the 54-hour moving average converges there. So that seems, if I had to pick some level that seemed like our most proximal level to go ahead and test out and see, okay, is this going to be a reversion point for us? Are we going to get something like that? That sticks out to me as the most meaningful proximal technical level. And okay, why not, Michael, right? Why not go test again after one pop? Like, why not go test the bottom of this? Well, I would say we might, right, get these half traces. So what we got here, we have multiple periodizations. So we have this pre-Thanksgiving periodization of up to the top line 1, kind of 2 again here, 3, 4 overextend beyond it, and then sell off pretty hard back down, and then kind of bounce a few times. Maybe one of these, right, on the channel. The channel was a little bit narrower back there, a little bit tilted up. So, right, bounce on these, we get kind of 1 bottom, and then up 2 bottoms with a test, and then up 3, and then up 4 again here, and now all the way up, and we reverse channel again, and now we're toward the top of the channel. So maybe this turns into a pattern. Maybe we get another periodization here where we get kind of a test the midline, right? Test this kind of mid area, overextend below the midline, back up 1, back up 2, back up 3, maybe into January Opex, and then we see what happens from there. Again, right, speculation at this point. We need to observe this on a day-to-day basis in order to really get a good sense of this. But I'm not sure I would expect quite so much of an abrupt move all the way back down to the bottom of the channel before we would see some kind of periodization maybe in this upper half. So, okay, so let's go and take a look at our options data and see what that says, right? Obviously, the thing that sticks out to us most is we're looking at a $30 max pain for this week. Interesting accumulation of options OI here, right? We have definitely lightened up in the 30 to 35 range. I mean, that's still where most of our call gamma or our smooth transitions between our call open interest is situated. So this is our highest likelihood of sort of intra-week and intraday price movement. Not a lot of puts added. We do have, our most likely put range, our bearish regime is back, 31 to 27. But we kind of have these overlocking brackets. And they're about, symmetrically aligned so that max pain falls right in between there at $30, at least for now. We'll probably see some more of this fill in as the week goes on. For this week, our highest call OI position is 35. So that's certainly forming proximally an overhead resistance, a call wall position for us, as we'll see in the gamma exposure data. But we'll get to this in a second. But we have actually so much also at 30, which is out at January Opex, that it's forming this. We're really going to be in this 30 bracket, it looks like. I mean, again, as I've said, ceteris paribus, without having externalities, anything huge to kind of break us out of this. Regular trading, regular options trading, share buying, that type of stuff is really going to keep us bound in that 30 to 35 area for our up and downs. And we can kind of see this, right, as we start to look out at later options expiries. This is not fully up to date. This is as of Friday. Chart Exchange doesn't open until market open. They don't update until market open. But right, we can see later options expiries for January, maybe February, converging on that $30 lower bound there. We have a few of them, right? So the ones monthly OPEXs or quarterly OPEXs accrue certainly. Interesting that July is already out there. Weird. Some people have also asked me this: why is it that there is no March Why is it that there is no March options chain currently? I do not know. That is a strange thing, why it's not there on Chart Exchange. I do have it when I look at Thinkorswim. So I'm not exactly sure what that means. I don't know why it doesn't show up. I don't know why we don't have options data for that. But I would put that up to Chart Exchange at the moment, rather than there being some sort of foul play as far as there not being that OI data available. But again, right, the point of bringing this up is to point out that for weekly expiries, we definitely see max pain values in the 30s. Now, January Opex is huge, right? We have over 500,000 contracts open for January 17 Opex, right? That's our leap state. And max pain is down at 21. Now, hard to get a read on what that means. That doesn't necessarily mean we're just going to go and collapse all the way back down there. Part of the reason why that is the case is that we have so little puts actually in this range that we've run from the end of October up until now over the past 2 months. There just hasn't been much put OI open between $30, say, and $20. We have, there's some at 20. There's 9,000 contracts at 25, but this is dwarfed by the size of call positions in that range. 22,000 contracts at 25, 31,000 contracts at $30. So what that is basically just saying in the max pain data, right? It's not taking into account premium values. Max pain, when I say something like, okay, ideally or theoretically or hypothetically or something like that, max pain is just taking into account the numbers of contracts. It's not taking into account premium values. So, even with this, right, it might not seriously jeopardize a close at around 30 for January Opex, might not seriously jeopardize market maker profitability, especially insofar as you might consider, well, when did they sell a fair number of these contracts? Like how many January 2025 30s did they sell in May when the price was $80, right? How many did they sell when the price was 25 in June, and it ran up to 45 and they got to sell, they offered $30 all throughout that. Like how many of those, right? How many of those when IV was at 300 something percent? And, people were buying these for $5 or $6 or $7 or maybe more, right? What's really, that you'd have to know to really figure out what their optimal profitability is, and don't have access to their portfolios, don't have access to that data. Even if I did, I don't know how much time it would even take me to figure that out. So just to keep that in mind, I don't really have more to say about it at this point than that. But because of that, right, there is one thing we do, because of the delta values on those contracts, there's going to, on all those in the money contracts, I should say, if the price really doesn't get pushed below 30, there's going to be a lot of positive pressure from dealer hedging, continuing to buy shares as there is positive charm on these contracts. As time goes on, their deltas appreciate. Now, there are also a lot of contracts out of the money. There's like 125,000 $125 calls. Like there's a ton at 100, there's a ton at 60 and 50. The delta values on these are low, but higher than you might expect, given how high GameStop's IV regularly is. So there will be some counterforce of negative charm from those. I'm not exactly sure to what extent it's going to fully counteract those in the money contracts and the amount of delta hedging that's going to take place and offer buy support. But it doesn't look to me like it would jeopardize at least the sort of stability of our trading within this $30 to $35 range, which is very heartening. We're looking at our fourth consecutive day with a 1-to-5 put to call gamma exposure ratio that generally projects a continuation of this bull trend. It's not a crazy, I wouldn't say that these ratios are terribly forward projecting, but at least it doesn't indicate, oh, hey, maybe I'm missing something in the gamma exposure versus the OI data, something like that. It's useful to take a look at, especially well, you never know, right? The trend data, I should say, may be more valuable as an insight than any individual figure, let's say, any individual ratio. But right, of course, the one that I love to look at, what's most helpful to me, that represents it helps represent the importance of later open interest positions, right? So not necessarily what's coming up on a given week, but it helps demonstrate the composite effects of dealer hedging across all expiries. So this is going to be the gamma exposure by strike table that I always mark up for you guys. As we can see, right below $30, little gamma exposure, not a lot, pretty neutral. Not really, it doesn't have too much effect on our day-to-day price action. We've got large amounts of net call gamma accumulation at $30.35, right? Even though we don't have that many contracts open this week at $30, I think it's only about 5,000 so far. What we do have is a lot of OI in mid-January, right, for January 17th at $30. And there's so much at that strike that it provides significant upward, I should say downside support, right? So upward, so volatility suppression as it is approached during this week's trading, even though it's that far out, right? So that you might not get that impression. You might think that position is potentially weaker given the lesser OI for this week's weekly options expiry, but the amount of it at 30, well, it still exhibits, right, that out of all of our strikes, it still has the largest share of all of our normalized GEX that's currently on the board, or gamma exposure that's currently on the board. $35, also a very big position, still projects, right? We've got it as a nice clamp on our trading. And then some stability in the middle of this range. So as long as our price is above 32 and we're not getting too much interventive flows, right? Not interventive shorting, we're not getting big externalities. That 32 to 33 range is our most stable trading position. As I said in the article, I think the path of least resistance for today and into the early part of this week is moving into this 30.50 to sort of 31.50 area. Basically, you don't have to spend, if you're a trader and you're an institution, you're trying to profit the most, let's say, from the biggest movements in the stock. You're trying to create maybe opportunities for big directional movements, right? Because you don't necessarily, if you're a trader, you don't necessarily care about the actual worth of the underlying from an absolute value sense. When you're purchasing, let's say, a call, you might want to trade long calls or intraday trade long calls or do short puts or something like that. You care about the prospective distance of a particular move in a particular direction based on where you are within the hedging landscape. So for example, if you're in the middle of this, you're going to look, okay, I'm going to do, let's say I'm going to do these little tiny things, right? 50-cent moves, 75-cent moves if I see us approach one of these levels, something like that. But if you're kind of below 32 here, if you're on the downside of 32, you're not necessarily going to bet on moves to 33 because you're to the downside of that volatility suppressive position. You are more likely to bet on capturing a downside move that gives you $1.50 or about $2 of movement down through this more neutral, slightly more slippery area that also gives you better bang for buck on, let's say, how much capital will move through that range, right? So if you're in this higher call gamma density environment, $1 of premium in the options market is going to have a lesser distance effect, let's call it. It's not going to push the price as far as it would in a lower gamma exposure environment because it's going to be counteracted or opposed, let's say, contrasted by a higher proportion of antipathetic dealer hedging. So dealers are, when you approach call gamma, right, it has this volatility suppressant character that when high call gamma accumulation positions are approached, dealer hedging works to the opposite, right? It contrasts movements that move toward it and, let's say, helps movements that move away from it, something like that. So you can anticipate as a dealer that, or as a trader, that, the price is going to move more quickly through here, which means you can take advantage of a downside trade that moves fast. You can take advantage of an upside trade that moves quickly through here. Your contract, if you're trading options, right, they're going to appreciate and depreciate. Number one, just more, but also more quickly or more profoundly when you're moving through these higher velocity areas, higher volatility areas. So like I said, I think that's path of least resistance, and it also sets up maybe something more favorable. Maybe some of the OI fills in here, the gamma fills in here, call gamma fills in here, and then there's a bigger reversal trade, again, back up to testing something like $34 later in the week. So maybe a little bit of bearishness early, we kind of trade in here, and then coming out of New Year's, we flip right up to 34, get another periodization there up to the top line of that bullish regression channel. Something like that. I could see that type of move occurring. If we stay above 32, we're probably going to be pinned in this area. Low volatility stuff, IV levels kind of go down a bit, and maybe we get something, we fade later, again, not including settlement stuff, not including something from the company, not including a post or something like that, right? Just kind of as a function of our inertia, let's say, something like that. So that's what I'm looking at, anticipating this week. IV, right? We've pretty much been grinding to the side here in IV. Not very profound changes, largely because we've stayed technically bounded. As long as we stay technically bounded, market makers, brokerages are looking at this and going, oh yeah, this stock is controlled. Like, we'll keep IV up because, reasons, but, there's no reason for them to try to manipulate in the sense of set or adjust IV into crazy high levels or crazy low levels, because it's not signaling that the stock price is moving outside of their like risk calculation models, or not signaling that to their risk calculation models that their profitability is at risk, and therefore they need to try to incentivize closing of long options contracts and the disincentivize entering into new long positions in the event that it won't end up being profitable for them. So yeah, so that's basically my outlook here. All of this looks great in terms of the long-term health of our bullish movement, right? We've had our 5th consecutive week closing above the 200-week moving average. The last time that happened was in, sure enough, December into January 2020 to 2021. Yeah, we've started to move off that line now. If we are getting a beat for beat requel, then the next signal for us to look at would be, say, 2 more weeks trading at this level, and yeah, the 8th week, of course, in 2021, which coincided with January Opex, was the day when stuff started to go exponential. That was also the week 2 days after which that Ryan Cohen filed his announced his intention to join the GameStop board. So maybe we see some company news develop something like that, or maybe the price just moves based on whatever these background mechanics are that are pushing up our price. So yeah, so that brings it to a conclusion for today. Look forward to seeing you guys tomorrow. We'll see what today's price action looks like. As always, thank you so much for your support. Thank you so much for watching and listening. Thank you very much for reading, sending feedback. Please go ahead, write comments, questions down in the comments. Look forward to seeing you guys tomorrow. We have video breakdowns every trading day and live streams. Right, we'll be back with our live stream this week. Questions after market close on Friday. So looking forward to seeing you all then. Thanks very much. We'll see you next time.